Welcome to Premium Cash Flow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to Premium Cash Flow Podcast. Today, I have the pleasure of welcoming Mr. Dynamic John Azar with the Mac Venture Partners. Welcome to the show, John.
Thank you so much, Scar. I appreciate you. Thanks for having me on.
Awesome. Thank you for taking time. John is with Mac Venture Partners. Today, with his brother, Tony, they manage well over just about 6,500 units spanning North Carolina, South Carolina, Tennessee, Georgia. They also own some assets in Florida and Texas here. And John has a great story where he immigrated in 1989 from Syria. And today, with such a large portfolio, it really is an incredible success story. So welcome to the show. I love that story, John.
Thank you so much. I appreciate it.
Right. I mean, I'm super pumped to hear your story, and I've been wanting and waiting to kind of connect with you. So I appreciate you taking time. Just give us a brief background, John, as to how things started, how it came about, and things like that.
Sure. Yeah. Brief background on me or on the company.
Sure. Everything. I think how you got started. I know you have your own property management company, Capstone.
Yeah.
As well.
Yeah.
So how things came about.
Sure. Yeah. My background, professionally, my background is have been very heavy in investments and finance. I came through the industry on the equity side of the house with Morgan Stanley and Royal Bank of Canada Capital Markets Group, and then kind of moved through to more institutional roles, getting involved in more institutional products. And I also had my own consulting company to do structured finance for commercial real estate, large-scale commercial real estate, mixed-use development. Mm-hmm. Back in 2004, 2005, I opened the company with two other partners, and we were doing mixed-use development, structured finance consulting. So we consulted on mostly hospitality conversion projects and mm-hmm. Condo conversion projects. And these were in major metro gateway cities like New York, Boston, Philadelphia, Miami, London. Mm-hmm. We had a few successful projects that spanning between 2005 and 2008. Mm-hmm. And you can imagine in 2008, things changed slightly. There was
quite a bit.
There was this whole thing in 2008 that happened to the economy, and
absolutely.
It caused us all to switch gears and do something different. So around the same time, my brother and the CEO of Mac Venture Partners, Tony Azar, was just starting Mac Venture Partners in the previous iteration of Mac Venture Partners. At that point, it was called Mac Properties and Capstone Multifamily Group. And in 2007, that was launched in multifamily. And in 2013, 14, I joined him in the ranks and trying to sort of take the company to the next level and become more private equity institutional in nature by funding, change our platform, sort of add on to our investor base, again, change our investor and investment criteria from a sort of an owner-operator platform to a more of an asset management platform. And we've done pretty well. Thank you.
That's awesome. And we will dig into that story as to how you scaled up, John, and how, things and the mindset shifts. And one of the things I interview a lot of guests on a podcast, right from beginning investors to advanced experience, seasoned investors like you, John. And one of the things that I observe all the time is that people who have a professional background, whether they are coming from let's say a brokerage like a Marcus Millichap or CBRE and things of that nature, or having a finance background, like somebody like you who came through like a equity finance shop and brokering various deals, understanding the numbers and things like that.
Sure.
There is a different mindset and how you go about analyzing it. And more importantly, it's that professional background that kind of scales you up, saying that this is how the big boys play. This is how you scale up. This is how your infrastructure tends to look like. And that's some of, that sort of theme is so evident all the way across than someone like me, for example, coming through a single family world and figuring their way out into multifamily and scaling up. So I just want to congratulate you and admire the fact that how that background shapes up. And for any listeners, I want to highlight that fact that pay attention to the numbers and how professional operators, like as big as you guys are, that they operate, what their mindset looks like, how they look at the big picture of things, and they adapt themselves. So I absolutely love that story.
Thank you. Thank you.
So, John, today, my sort of effort today is to kind of get behind your operations as to how your deals are structured, how you manage them. Of course, you do the value add and things like that. So we'll get into some of that. But more importantly, I want to get behind into understand that, okay, you grown now at such a large scale that I want to, understand that what it took, what were the sort of the changes around you, whether it's office staff, property management, things of that nature, or different relationships that you may have established. Give us an overview that how a beginning investor can evolve from going from, let's say, 10, 15 deals to 100 deals to 500,000, 2,000, what it takes to get to that level.
Yeah, I mean, it's look, the evolution of any investor or any entrepreneur in the multifamily and commercial real estate in general is going to be different.
Sure.
Their evolution and their journey may not be the same as our journey and my journey and evolution into the business, but every journey does have its own set of inflection points. And I always talk about different inflection point in the business and different set of points that you get to that you have to shift and reshift your business and look at it a different way. Because when you get to start, and those inflection points specifically have to do with size and the size of assets that you're managing and what you're managing. So when you get to 500 units, you're not going to be conducting yourself the same way as you used to be conducting yourself when you used to only have 50 units or 100 units. When you get to 1,000 or 1,500 units, you're not going to be conducting yourself the same way as you used to be when you used to have 500 units, and so on and so forth. So, each growth cycle or growth stage demands its own different set of expectations, both internally and externally. You start to conduct yourself internally differently, and you start to externally deal with your external partners also differently. And those set of external partners start to also change and shift, and maybe either get more sophisticated in nature, depends on your business, or not, or maybe just in size.
Right. So let me maybe paraphrase also, John. What specifically changed around you in the last, let's say, 10, 12 years? So let's say, you were at, whatever deal size, what was your size during the first deal? Then, as you grew, you probably added more staff, you established more relations. Could you maybe give us more insights into, how, intangible ways that how you grew and what it took to get to that size? Walk us through that progression, if you don't mind.
Absolutely. Yeah, no, absolutely. Yes, staff is certainly one thing. The more that you grow in deal size and the more deals that you acquire under your belt, obviously your relationships with your financial partners are going to change. You're going to have more financial partners. Hopefully more lenders are going to be able to or be willing and excited to do business with you, because you're obviously, the more deals you do with them, the more your reputation with them and your track record is going to improve. So going from 1,000 units to 2,000 units, or 3,000 units, or 4,000 units, you're gonna have to you're adding on to your team, because that's what they are. They are part of your team. So your team involves lenders, your team equity partners, your team involves lawyers, accountants. Your team involves auditors at some point. You're going to involve, you're going to have to, at some point when you get to a certain inflection point, get an auditor and auditing staff also on board. So that team dynamic is changing internally as well as externally. Those partners I just mentioned, they could be all external partners, not internal. Then your internal staff also changes. When you are managing 1,000, 2,000, 3,000 units, maybe even 4,000 units, you might be still in the mindset and mentality of an owner operator, or just an operator of real estate. Then at some point, your assets under management and the size of portfolio is going to dictate that you have to become more of an asset manager. And that mainly has to do with a lot of your internal factors and internal processes and how you handle yourself internally and structure your company internally as well. So, simple things like, maybe changing your controller to a CFO, or getting more sophisticated accounting staff internally, hiring an external auditor, so you're not only controlling yourself internally, but you're also having an outside auditor and making sure that you're doing things right. And these are all good fiduciary things to do for your investors, not just for yourself also. Right. Your investors, the more sophisticated they get, especially if you start to deal with more institutional level investors, they are going to expect those things. I mean, that's going to be part of what their set of expectations are going to be in order for them to deal with you. I mean,
that's awesome. That's exactly what the answer I was looking for, John. I appreciate you sharing that. Whether you go from that Excel spreadsheet showing the returns to, having those audited results that are audited by your external, CPA and things of that nature. And you rightfully mentioned the fiduciary responsibility and what the deadlines and all the other stuff that comes with it, that you have to have all those different systems in place to be accountable to your investors. So another question related there, John, is that at your size, do you tend to have more institutional capital involved in your deals, or do you still have a lot of predominance of individual investors? Could you maybe give us insight into that?
We have all. I mean, it's deal size driven. We're still blessed to have a good stable of investors, individual investors, accredited investors, and we are still welcoming accredited and individual investors. We deal with them on a regular basis because it really depends on the size. If the size of a deal is less than, for us, if it's up to $5 million in equity stack and equity size, we tend to try to keep it in-house. It's a lot easier for us to just source that equity in-house from our stable of investors that we've grown for the past 12 years than it is for us to involve anybody from an institutional nature. Between 4 or 5 million and about 8 or 9 million, really 9 million is probably going to be a smaller to medium-sized private equity investor, a private equity company that would be involved in our deal. And maybe a combination of both. Maybe a private equity company would come in and we would still be able to participate with some of our own investors as well as part of the carve out. Then once you get to 10 million plus in equity stack, then all of that, then it becomes purely institutional at that point. So anything beyond 10 million, 9 or 10 million, it switches to an institutional investor. It's just a lot easier for us to deal with at that point with an institutional investor that would come in and participate with one equity slug, as opposed to trying to go out and source 100 different investors.
Sure. And just a tip for our listeners, that what John is talking about here is that the equity stack is your sort of your 20 to 30, 35% depending on the deal and the capex and things like that. So if you're talking, let's say, a $5 million equity stack, generally that deal size would be in that 20 to 25 million range. That would be the deal size. And perhaps when you hit that 9-10 million of equity stack, you're talking deals that are generally, I'd like to say maybe like $40-50 million deal size, spanning maybe like 500 some units generally. Would that be a correct characterization?
Up to about 5 million equity stack. You're talking about a deal that's probably going to be closer to the $20 million range.
Right.
The $10 million is probably going to be closer to the $35, $40 million range.
Got it. Got it.
Awesome. The deal size parameter, because you got to always average in. You calculate in a simple calculations, calculate about between 70 and 72, 73% debt that you're going to get, that you leverage that you're going to get on those assets.
Right. So speaking of deals, John, could you maybe give us an overview of generally how you like the framework of your deals, like GP, LP, preferred returns, things like that? How do you go about structuring your deals?
We structure our deal both as, obviously we are the GP in the deal in all our deals, but we are also participating on the investor side as well, on the LP side. We put in our own money, our own cash in every single one of our deals. So we always participate. We always have skin in the game in all our deals. Even if it's an institutional size deal, we're still going to have our own skin in the game.
Sure.
Because that's just fair. It makes us, on the same side of our investors. We are making money the same as our investors are making money, and we're incentivized by the same set of incentives that's going to take to make our investors money. So we generally have an LP structure and a GP structure. Most of our investors, if they are passive investors, are going to come in on the LP side or what's known as limited partner sides. For those who don't know what the acronyms are, the GP side, or GP, stands for general partners. General partners are usually the controlling entity or the managing entity of the deal. So we are the GP on all our deals, but we also put in money. Our money spills over into the LP side as well. So
awesome.
We are on both sides of the equation.
Right. And what about preferred returns and splits and things like that? How you generally go about that? I know, a lot of this is deal specific, but just a general framework.
Our returns are we have a pref return or a pref rate, cash on cash rate. There's different, again, variants of how investors know that word. If investors are coming in from they're used to the wording of the bond and equity markets. Stock markets, it's known as a dividend or a dividend distribution. Or a coupon rate, that's all the same thing. It's all cash on cash. That's what I mean. So the cash on cash or the pref rate usually is we have a starting minimum point on every deal, and that's usually average about 8% starting point. So we start out at 8% cash on cash. We try to keep all our deals at around 8%. Some of them may, it's in a tough market environment. Some of them may come in a little bit lower for guaranteed pref. And then obviously we scale up from there. A lot of, if we're lucky, we're able to find deals that are cash flowing, double digits within, hopefully after a year. And maybe by year 3, they're cash flowing in the, 11, 12% range. So that's the cash on cash component of the deal. Then obviously they're making money, the IRR of the deal, they're making money on the sell or the liquidation event, which is the upside of the portion of the deal. And that usually happens 4 years, 5 years down the line when we actually liquidate or refinance, or there's some kind of a liquidity event that happens 5 years down the road, which brings you to the point of how long we hold our assets. Right. Most of our assets, our average hold time used to be 3 to 5 years. Up until about a year ago, we kind of extended it to between, now the sweet spot is between 4 and 6 years. Just because of the market environment, it's become a lot more difficult to have deals with good cap rates, exit cap rates that are going to satisfy those cap rates within 3 to 5 years. So we have to extend it by about a year or two to be able to capture better cap rates at exit. So which means longer hold time for the assets. But again, not too much longer hold time. We're still talking about within 4 or 5 years is what our expectations are.
That's awesome. And thank you for that detailed answer, John, because you answered some of my follow-up questions as well as to, like how long would you like to hold the deals and things like that. So on that related topic, John, what is your investment philosophy? Are you more into buy and hold of these deals long-term, or you try to improve your batting averages, that whatever makes sense, you sell it, move to bigger, better things. And somewhere along the way in future, you would like to hold quality deals for the long term? Or is it the other way, like saying perhaps that I don't want to hold the deals long term. I just want to, exit out of it and not really go the lifetime or the premium cash flow, as I call it, away. What's your take like in these situations?
Well, I mean, we tell investors to expect 4 to 5 years. That we hold all our assets that long.
Mm-hmm.
No, some assets are held maybe slightly shorter. Some assets are held slightly longer. Those assets that are held slightly shorter, maybe we've achieved our return parameters. We've achieved our turnaround plan for the rehab of the units.
Mm-hmm.
We've achieved our rent growth projections. And 3 years down the road, somebody comes to us and gives us an unbelievable offer on the asset. Why would we turn it down? So
sure.
We did that recently with an asset that we owned here, and we sold it within 3 years of owning it. So that was shorter than the timeline that we initially expected. But
sure.
The investors made a good amount of money, and
sure.
the assets performed fantastic. And some assets are cash flowing like crazy, and the investors get greedy. We do too, because if you have some assets that are producing, older assets that are producing 15-16% cash on cash. I mean,
that's awesome.
You're not going to get that. And you sell it and you go into another assets that are going to produce maybe 12 or 11%, and investors are like, no, we don't want to sell out of this asset. So,
No, it's sometimes, as you indicate, it's more about what's the beneficial interest of investors, putting their interest forefront and guiding that philosophy that way, I guess. So, thank you.
You do. I mean, but you do have to have some other restrictions as well. I mean, you don't want to hold an asset. I mean, we want to adhere to those investor expectations, but at the same time, I don't want to hold an asset for more than 10 years. I mean, that's way too long. I mean, that's not our investment philosophy. That's not our investment mandate criteria. And that's what, again, going back to sort of the difference as you go through the machinations of becoming an asset manager,
right.
You have to have start to set a certain set of expectation and certain investment mandates for yourself internally. And those investment mandates have to be somewhat strict, and you have to be strict with yourself, how you enforce those investment mandates, because otherwise, you say, well, what's your average hold time? And I'm going to say, well, I don't know, anywhere between 1 to 10 years. Who wants to hear that?
In other words, you don't know what you're doing.
Yeah, that's exactly right. That tells you I don't know what I'm doing.
I know. I love that answer. So speaking of that, John, I know you indicated sort of in an indirect way there that you are looking for value-add propositions, value-add deals.
Yeah.
And typically that means you buy slightly, inferior assets, whether it's inferior assets in good areas and things like that. Could you maybe give us some inside scoop on your value add strategies, what you like to see in a deal, and what makes you take, what passes sort of your first napkin math when you see a deal come across your desk? What merits further due diligence? Could you maybe give us insights into some of these aspects, please?
Sure. Yeah. I mean, we are in the value add space. I mean, which means we buy in the B class. So we are, again, for those of you who are not familiar with the different class sizes, we are, usually a lot of commercial real estate comes in A, B, C class sizes or classes, and we are solidly in the B class. That's what our niche is, which is also better known sometimes as workforce housing. We satisfy the demand of the average working professionals. We're not selling luxury. We're not renting luxury properties, but we're also not renting a lot of inferior, lower class properties as well. So we are that sort of solid B class range. And some of the initial napkin math for those would be obviously what kind of cash flow they're going to generate, and that formula of cash flow involves how much are we putting in capex, how much are we spending on the units per unit price, and that capex, what does that translate? What kind of ROI are we going to get on that capex? You know, if we are looking at an asset that requires, you know, a rehab of the kitchen and the floors, are we putting in $3,000? Are we putting in $5,000 per unit? And those $3,000 to $5,000, how long is it going to take us through rent bumps or rent increases in the following 3 years to make up that difference, to make up that money, that capex that we spent on the unit. And hopefully the math will come out right, that we'll, within a certain parameter, time parameter, 2, 3 years, 4 years, whatever it is that you set forth for yourself, you will make, you know, that's how long it will take you to capture that money, and the ROI will start to obviously increase further after that. And a lot of our deals, when we buy them from a debt or leverage perspective, we always try to have some kind of an IO component or interest only component built into our structure, built into our loan. And the reason interest only is important is because you need that interest only component for the first 2 to 3 years of your ownership in order for you to implement your value add strategy, in order for you to essentially rehab the units. Because you can't take over a 200 unit complex and expect on week 1 that you're going to turn around all these 200 units and rehab them all at once. That's just, that doesn't happen.
Right.
The way that you rehab the units, you rehab them on turn, which again, what I mean on turn, meaning when the
turnover happens,
vacate, and you are getting ready to get the next renter in, that's a turn. So you're rehabbing those units based on the turn. We've streamlined our process so well that our timeline of rehabbing units between turns is literally eight days. So we really need about 8 days, 8 to 10 days at max to rehab those assets to where we want them to be, and turn them back out into the marketplace and re-rent them. So
That's awesome.
Yeah.
And thank you for that detailed answer there, John. Speaking of those rent differences, so when the deal comes across your desk, John, what sort of rent differential you're looking? So when you project your pro forma, let's say whatever, 2 years, 3 years down the line, are you looking for 10% minimum rent difference you're trying to get to, or you need like a minimum 20-25% rent differential to kind of further analyze the deal? Could you maybe tell us how you're going to go about that?
Yeah, let's come back to earth. There's no 20%. That's you mean I might have to rebuild the whole thing to get 20%. Right? That's pretty ambitious. We generally build in. So general rule of thumb is that you build in about 2 to 3% organic rent growth on most areas and most markets. If it's a healthy market, healthy apartment market, that has some growth in it and some good demographics, you're building in about 2 to 3% organic rent growth. Now, what that means, organic rent growth, meaning you don't have to do anything to the unit in order for you to increase rent. You're really increasing rent just based on the inflationary economics of the area. That's it. Right. So you take that 2 to 3% inflationary rent growth, organic rent growth, and then think, what capital improvements am I putting into the unit in order for me to achieve some additional rent growth beyond that? Can the market sustain granite? Can the market sustain stainless steel? Can the market sustain, a better gym, better amenities? Can I improve the clubhouse? Can I offer dog parks? And putting in all these things obviously costs money, but if I put those things in, am I going to be able to get another 3, 4, 5, 6, 10% rent increases in order for me to implement those things? And you have to do your market research. I mean, there's no set amount that I can tell you right now, Scar, that hey, we always do that number. It's not that simple. I mean, you have to look at what the market can bear. That's why it's very important to do your comp and comparable research in the marketplace. And that's why we extensively do comparable market research when we do our due diligence. And not only on paper, but you actually physically have to go to the area and drive the area around. There's so many people that will look at an asset on paper and it looks amazing, but you go and start to speak to the comparable assets nearby. You talk to the property managers of those assets. You talk to sometimes vendors that are around. You talk to store managers. I mean, we talk to a variety of people, not just apartments. We sometimes we sometimes go to the Chamber of Commerce and say, hey, what's going on in the area here that's going to make it pop in the next couple of years? Is there something exciting coming in? Is there a Microsoft or a Google facility or an Amazon facility that's coming by?
Mm-hmm.
So these are all important factors that are going to go above and beyond to determine your numbers and the confidence you have in your numbers in order for you to implement those rent increases and for the life of the asset that you're holding.
Right. So, John, give us an example of a successful deal you acquired. You sort of added the value, achieved the rent bumps, and sort of exited, meaning sold the asset and achieved the returns for your investors. Give us an example of some of that, please.
Yeah, sure. I mean, we did a deal, a pretty sizable deal in Statesville. North Carolina here, and we actually did a couple of different deals that are good. One in Rock Hill and one in Statesville, and we bought the asset and we did our value projections in it. We had in both of those deals, we had about anywhere between $3,000 to about $5,000 per unit as far as the rehab cost is concerned. We held the assets for about 3 years. And within 3 years, and especially with this current market dynamic, we started getting offers from private equity guys and some even bigger institutional players for a price that we really simply couldn't ignore. So we were able to sell out of that asset within 3 years, even though it was less than what the time frame that we projected to hold it, which was about 4 years. So it was about a year lower than what we projected to hold it, but we achieved the returns a lot quicker than we thought. And
that's always a great way to exit before your projected performer years.
Yeah, and in the case of that, it's the one of the properties is called Carolina Crossing, and we did we did a decent amount of exterior work. We did some work to the clubhouse. We did work to some of the units, and by the way, in general, we don't do 100% renovations to 100% of our units.
Thank you for bringing that up. That's an awesome point that I did wanted to ask you. That there's this philosophy that don't do everything yourself. Leave something for the next guy to chew on.
Correct.
Or leave some meat on the bone, as we say it, right?
Correct.
Could you maybe tell us why it's so appealing that or it's built in your pro forma that you only do a certain percentage? Why it's that so important?
Well, because it's important. It's important to look at who you're going to sell and who that buyer is going to be. We approach every single one of our deals from the beginning to think who is going to be our buyer 5 years from now or 4 years from now, and this is what we think about before even buying the deal. This is this is something we think about as we are doing our due diligence, as we are doing our projections and pro forma. Every deal we look at, we think, okay, so 4 years from now, who is this deal going to be appealing to? Who is going to be the typical buyer? Who's going to be the ideal buyer for this? What are they going to want to see 4 years from now, 5 years from now?
Right.
And that's how we structure our entire deal, based on who we think that is going to buy that deal 4 to 5 years from now, and what they're going to want. And that dictates anything from debt. That dictates our renovation plan. That dictates how many units we renovate and turn around and rehab. And it dictates how we manage the property. So all of that factor goes in the beginning. So we front load the expectations 5 years from now, today. And that's really what makes the deal successful for us. Because if you don't go into a deal with the mentality of how am I going to handle this deal 5 years from now, you're really kind of shooting yourself in the foot.
Thank you. Begin with the end in mind, basically, right?
Begin with the end in mind, and kind of reverse engineer what you think that buyer is going to look like. And just to backtrack on that, I mean, so one of the things I just mentioned is debt. So a lot of our debt, we take long-term debt, and a lot of people look at it and say, why do you take long-term debt? Why don't you there's a lot more attractive, lower-priced options that you can take with either bridge loans or mezz loans or 3-year ARMs or something like that. Right. And the reason we do long-term debt, which is usually anywhere between 10 years to 12-year permanent debt, is that we think that the mentality of what that buyer looks like at the other end, because we want to leave not only meat on the bones for the apartments, but we also want to leave them an option to do an assumable loan, because today's rates are so compelling and so competitive. 5 years from now, they may not be. So maybe if you can lock up something today at, let's call it, I don't know, 4.5%, 4.75% interest rate. 5 years from now, if the interest rates are 6%, my goodness, that property is going to be really attractive to whoever.
Absolutely. You just created a just automatic value by having a lower assumable loan,
exactly,
lower rate.
Exactly. And they'll have another 5 to 7 years left on the loan that they can assume.
Sure.
So it's a win-win.
100% agreed there. 100% agreed. That's awesome. Just speaking of that, then John, you were talking about that deal, right? How was the exit? Like, what did you what sort of IRR or cash on cash return was returned to the investors? Going back to that conversation.
Sure. Yeah. The cash on cash were averaging double digits in that deal. Throughout the 3 years, they were averaging double digits, and then at the time of the sale, the IRRs came in the mid-20s range for those investors. Actually, more like up to about 20, between 26 and 27. So it did really well. It did really well. We exceeded our expectations, our performance expectations by about 20%, 25% above and beyond what we originally expected to return. So, anytime you can return to their investors over 2x of their money, it's a home run.
Right.
Somebody was to put in, and just to backtrack again, to explain to those listeners, that's a huge factor in when you're looking at a deal is
absolutely
X returns of the deal.
Right. The equity multiple, as we call it.
The deal multiples, exactly. So if which means if somebody puts in 100,000 with us today, 3 years from now or 4 years from now, when we exit that deal, if it's 2x multiples, then that means you're getting 200,000 in total out of your investment with us.
Correct.
That includes both the cash on cash and the IRR bump that you're going to get at the sale.
Absolutely. And just to make it further clear for our listeners, the way it works is that you're getting a dividend or a sort of a coupon clipping return as the returns are coming in, or you get it from the cash flow, whether it's monthly or quarterly distribution. So that's your ongoing process, but the bulk of your money is coming from, or the gain is realized from when the property is sold. So thank you for that, John. Couple of questions. I know asset management is such a crucial and such a dear topic to all of us. Could you describe us as to why you self-manage your assets? And I guess before we go there, John, I'd like to kind of understand that you have a portfolio that's spread out into multiple states, right? So what goes into creating such a management company and operating it? Could you maybe give us some insight into how you go about it, why it's so important for you to own your property management and things like that?
Yeah, absolutely. I mean, it 2 words: cost control. I mean,
absolutely.
That's the main reason why we like to have our own asset management or property management company in-house.
Right.
We have better handle on costs. We have better handle on personnel. We have better handle on operations. It gives us a better handle on the market. It just gives us a better handle on managing a lot of our properties more effectively. Therefore, giving us better returns on our investments to both us and to our investors.
Right.
Is it a huge moneymaker for us? No, it may not be. But it is a moneymaker for us because it helps the other side of the company as well.
That is very crucial, and I can relate from my personal experience as well in that, John, is that the cost control and some of the control that you bring in, I think it gives you a guarantee to keep things in line with, how it is, because the last thing you want is, kind of get into a scope creep and, all those things and just headaches that come with all of that. It's just, I mean, the stories go on and on. Tell me, John, like how do you go about having this multi-state property management company? I mean, obviously you need a lot more resources, crews, and things like that. How did you grow that property management to such a large scale into different states?
You have to, I mean, it's hiring the right people, and people are probably the most essential entity right now in this business. People are very, very, very important. And they are probably the most difficult and probably the biggest pain point out of any company.
Sure.
People are a huge asset to a company. The right people are a huge asset to a company. The wrong people are the biggest hindrance to a company.
I totally agree. Finding right talent is so crucial. And a related question there, John, is that people or operators who are as advanced at your scale, typically what they have done is they have established allied other businesses, whether it's you create a spin-off for trash hauling, or whether you have your own AC repair or air conditioning sort of a technical services team and things like that, whether it's dry cleaning. I mean, stories goes on and on. Somebody has established a landscaping company and things like that. Does your company tend to do that, or you subcontract a lot of these things and you kind of keep the core management of units and things like that only to you? Could you maybe elaborate on some of that?
Yeah, we subcontract some of that, but to answer your earlier question about how you handle a multi-state property management company, you employ the right people in the right places, but then you have to also create certain different levels of management. So in a very simple way, all your properties are going to have property managers. They're going to, and property management is going to be dictated on whatever the size of the asset is or the apartment complex is. Typically, the rule of thumb is for every 100 units, you're having a 1-in-1. So one internal and one external, meaning one property manager or one leasing manager or leasing agent and one
maintenance person,
maintenance personnel. So
sure.
So as you can do the math as you grow. Does that mean a 200 unit complex will only have 2 people internally, a property manager and an assistant property manager?
No.
Most of the time, yeah, but it doesn't necessarily. It depends on the complex and the complexity.
Yeah, and I think there are some assumptions within it as well, right, John? That in the scenario described, right? From what I have learned is that you have assumptions there. Is that you're subcontracting your drywall, your kitchen rehab, and things like that. Where there are other operators where we say that, oh, geez, if I have 100 units, I'm going to have one leasing staff, but I'm going to have maybe 4 guys who are doing different kinds of things. One could be just doing, just the cleanup and sort of the porter type of job. Whereas you've got these other 3 guys who may be doing the painting, the drywall, or the kitchen, like, the light handyman type of.
The rule of thumb is you got to have at the very least your full-time staff have to be the one that takes care of your punch list items. So the punch list items, and when I say a punch list item, meaning, when they do painting and cabinet repairs and AC repairs, HVAC repair, plumbing issues, those punch list items that usually come up with, renters, on a day-to-day basis. Like, gee, my toilet is overflowing, and on my, I had a hole in the wall. I have I have some electrical outlet that's out. My AC is not working. So these are all punch list items, and you have to have people on staff that will take care of those punch list items. As you do more involved rehab and construction issues, those are not necessarily have to be in-house. Those you can outsource. I mean, you can outsource drywall guys. Because how often are you going to really do complete drywalls? I mean, why employ somebody full time if you're only going to do drywalling, once every, 3 months or 4 months or whatever.
Right.
So you employ, or maybe even you might do it every month, but you might only need it for that one day out of
Absolutely. Right.
So you employ some of the more expensive stuff out, instead of keeping somebody in house all the time.
Makes sense.
If you're doing something, some major construction, obviously that's outsourced. If you're doing landscaping, usually sometimes you can outsource that as opposed to keeping it in house, because a lot of guys that are doing punch list items sometimes they're not that good at landscaping. So so you employ an outside landscaping company to take care of that for you. So so really it depends. I mean, you want to minimize the people that you'd want to pay full time.
Absolutely.
To only the essential, that they can take care of the essentials that you need for the turns and for the maintenance of the apartments. Everything outside and above and beyond that you're only going to need on a temporary basis, you outsource that to somebody else.
Makes complete sense. Makes complete sense. So, thank you there, John. And another thing we talked about, John, is the mentality of real estate operations versus, taking the hat of asset management role, right? So,
Yeah.
in your company and at the level that you are, John, what is your capital raising strategy? Like, do you have multiple funds or a fund that's open that you typically intake capital into it and you deploy into the deals? Or are you, because of the relations that you have now, you raise capital on a per deal basis? Could you maybe give us some insights into that?
We do all of the above. We do have our internal funds. We have some targeted asset funds that we keep money in on a regular basis to go after certain assets. And these funds are funded by our stable of investors and our own cash as well.
Sure.
We also, obviously, as I mentioned earlier, it depends on the deal size and the equity stack of the deal. We obviously work with private equity people. We work with institutional guys on bigger deals. It really just depends on the size of the deal and what type of equity is needed. We again, just to reiterate what I said earlier, we always put in our own money in every single one of our deals. We always have skin in the game in every deal, but but where that money comes from is usually a combination of our own safes and coffers and our own funds, internal funds.
That's awesome. You got all the engines firing off, whether that's a Rolls-Royce engine or a heavy Falcon engine. You got all them going.
We got to, man. We got to keep that. You got to keep that Ferrari going, man.
That's awesome. That's awesome. I know, John. It's been a pleasure, and we are well into in-depth conversation here. One last question for you, John. Knowing the state of economy the way it is, I mean, a lot of investors are having one heck of a time finding proper deals that pencil out. It's fair to say that there's gonna be some reckoning or some shape or form of softening that's gonna happen in the market. What is your take on where we are at the state of economy and how it can affect real estate, whether it's multifamily classes, office, industrial? Could you maybe give us some insights on what sort of your take on this is?
Sure. Yeah. I mean, we're definitely expecting some kind of correction in the marketplace. I mean, but and I say it lightly because we don't know how steep or how much the correction is gonna be. We are already going through some correction in some certain metro areas. A lot of major metro areas like the New Yorks and the Boston and even Charlotte to some extent are experiencing a little bit of correction on the A class, and there's a differentiation between A class and B class, and what we're going to be going through in any economic cycle. Economic cycles affect different classes differently. A class is going to get affected by downturn a lot more steeper and quicker than B class. And the reason that is because if you look at A class and B class, and I always say that to people as they're asking me about why we excel in the B class workforce housing, where we feel confident and we feel like there's a lot more safety in there, is because if you take somebody who is renting a luxury apartment and paying let's call it maybe $2,500 a month for a 2-bedroom apartment, and something happens, God forbid, to their job, they lose their job, or something happened to their family, they're going to try to look for something that's very comparable in amenities, maybe even in the area. But for a lot less money. So in order to do that, they're probably their first stop is going to be us. Their first stop is going to be a B class apartment. And the delta between an A class and B class is much bigger than the delta between B class and C class. The delta between A class and B class is huge. So if they can go from a $2,500 a month apartment and go to a B class apartment and probably shave off at least $1,000 bucks.
Totally agree.
Go to $1,500 or $1,400. Still get a product that is very good, that gives them all the amenities they want, but they're paying a lot less. Now, if for people who are already living in B class and something happens to them or to their job or whatever, they may think twice about going to a C class, because when they go to C class, they're going to experience a lot more drastic change. Amenities, they're going to experience drastic change in the areas. They're going to experience that change is going to be so much more drastic, but the money is going to be less effective than between A and B. They're not going to save $1,000 by going to a C class. They might save $500 or $600. They're not going to save $1,000. So the saving delta is going to be much smaller from B to C than it is from A to B.
That's why you are in the B space as B class, that knowing you have the sort of the resiliency of whether the market softens and things like that, you will still be protected. So
exactly. And we see a lot of, we hope to see a lot more deals. Actually, in 2020, we're expecting the buyer pool to contract a lot, and we expect that it's going to be a lot more buying opportunities for people like us in the solid B class space, and by about 2020, 2021. And we're, I don't want to say we're looking forward to it, but we are somewhat looking forward to better buying opportunities for us and for, people that we're helping. We're launching a coaching program that we're hopefully going to be helping other people buy some similar apartment complexes.
That's awesome. So thank you, John. I greatly appreciate your detailed answers. I think you added such a tremendous value in terms of telling us the tactical stuff and also the mechanics on the ground, what goes on, and also the high level stuff where, how you scale your company and things like that. So I appreciate your detailed answers today, and thank you for your time. Please share with our listeners where they can find you and locate you.
Sure. They can locate us at the www.macvp.com, MACCV as in Victor, P as in Paul.com, as Mac Venture Partners. Or they can email me directly at John at maccvp.com, John at macvp.com. Or they can find me on Instagram at JJ Azar.
Wow, there you go. Instagram. Awesome. So it's been a pleasure. And for our audience, if you have any questions, if you're interested in joining any for our future investment opportunities, Premium Cashflow Capital also plays into multifamily, self-storages, and manufactured home parks. Time to time, we always have several lucrative opportunities. Please look up on the website, premiumcashflow.com. Very simple, premiumcashflow.com. So thank you, John. It's been a pleasure having you. I think at some point I would love to invite you back on another topic where we can dig in.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.